The founder and CEO of OpenAI, Sam Altman, says we could be in an AI bubble. The Buffett indicator is showing that the stock market is extremely overvalued, while at the same time, people are calling this the AI billionaire boom because nearly 500 new AI companies are valued at $1 billion or more. That's why we need to talk about the similarities between the dot-com bubble, the huge risk for passive index fund investors, if the stock market is going to crash, my thoughts, and exactly how this could affect you. First, we have to start off with what is a bubble? I'm sure you've probably heard the term thrown around, and if you haven't, a stock market bubble happens when the stock prices rise extremely high, not because of profitability or value, but because of fear, FOMO, hype, and excitement. Basically, people aren't buying because the companies are great, but because they think that the prices are just going to keep going higher. Then, at some point, the sentiment changes, and as everybody rushes to the door to sell, the prices start to come crumbling down, and in almost an instant, billions of dollars are wiped out. And we saw this happen in the year 2000 during the dot-com bubble. When it finally popped, the NASDAQ lost over 70% of its value. Okay, so now that you know what a bubble is, what exactly happened during the dot-com crash? At the time, the internet was new and revolutionary, and people thought it was the future. And I mean, they're not wrong, right? You're watching this on the internet. But the problem is there were companies that were coming on the stock market, in some cases with no actual product or profit or revenue, but with just an idea and a website. Then thousands of people would speculate driving up the stock prices, but with no actual profitability, combined with the fact that at the time interest rates were rising, meaning borrowing became more expensive, this ultimately led investors to realize that these hype companies might never actually turn a profit, and they started to pull their money out. And when the first domino fell, the party was over. It came down so quickly that the NASDAQ dropped more than 25% in a single week. Okay, so now that we know what a bubble is and what happened last time, what's going on now? First, a lot of people don't realize how exposed to AI they actually are. See, you might be sitting there saying, well, I don't own any NVIDIA, Apple, or Google shares, so I'm not gambling on AI. I'm diversified into index fund ETFs that track the S&P 500. And I'm also on your side. I'm mostly invested into passively managed index funds. But here's the problem. See, most people don't realize that the biggest companies are invested into AI. They're all in on it, like NVIDIA, Microsoft, Apple, Amazon, Meta. And you might not realize that index fund ETFs aren't as diversified as you might think. Hank Green recently released a video going over why he's shifting his investments because of AI. And what you need to know is that when you invest in an S&P 500 index fund, yes, technically you are investing in the top 500 companies, but your money isn't split equally. It's weighted by size, meaning the biggest companies get a much larger share of your money. For example, every dollar that you put into the S&P 500, the top 7 companies take between 34 and 35% of it, and the remaining amount is split up between the other 490 plus companies. NVIDIA alone makes up 8% of the S&P 500. When you realize this, you start to understand that you're not as diversified as you probably thought. And keep in mind that during the dot-com bubble, the entire tech sector made up 34% of the S&P 500. Now, just 7 companies make up that same 34% of the S&P 500. But it actually gets worse because not only are you and me investing in the S&P 500, but more and more investors every year are turning towards passively managed index fund ETFs. And as more people invest in these index funds, more money goes to the top companies, which means their values go up, which means the next time you invest, more and more of your money goes to those top companies and it just becomes a loop. Now, this isn't done accidentally. You do want to be exposed to those top companies because typically the top companies make the most amount of money. And I can already hear people saying, AI is the future, we're all just betting big on it. I mean, come on. Everyone is using ChatGPT. These companies have to be making a killing. Well, not exactly. See, OpenAI, the owners of ChatGPT, have literally never made a profit. Now, a lot of startups don't make money initially, but AI is increasingly losing more and more money year over year, and they're doing this for growth. At some point in the future, they'll eventually turn a profit. At least we hope. See, a company like OpenAI needs to build these massive data centers to process large amounts of data, but they don't have the money to do it themselves. So they partner with NVIDIA, who agrees to loan them $100 billion, but obviously NVIDIA isn't going to do that for free. So NVIDIA puts in the agreement that OpenAI will buy NVIDIA GPUs to fill up those data centers, and they also take a small ownership in OpenAI. So basically, NVIDIA invests into OpenAI. OpenAI then takes that money and buys NVIDIA GPUs. Nvidia profits, and then reinvests into OpenAI, and the cycle repeats. And it's not just Nvidia who's doing this. Another major chip maker, AMD, recently partnered with OpenAI. OpenAI agreed to buy a ton of AMD chips. In return, AMD is giving OpenAI stocks worth almost 10% of the company. So as a result of this deal, AMD stock price went up almost 25% in a single day. And since OpenAI is now becoming an owner of AMD, they're making money off buying their own chips. And if this all sounds extremely confusing and a little bit weird, it's because it is. They're literally just passing money around in a circle. And the risk is these companies are becoming more intertwined. So if AMD can't ship the chips fast enough, or if OpenAI can't pay back Nvidia, then it could drop the entire market. So between the weird financing and no profitability, does this mean that everything is going to come crashing down? Well, what these companies are betting on is the long-term exponential growth. And like I said, AI is the future in my opinion, and it might genuinely change all of technology. And although there's a lot of similarities between the dot-com bubble, one of the biggest differences is that the companies like OpenAI, yeah, they may not be profitable, but they still have revenues in the billions, unlike the dot-com startups, which weren't even real companies. As well as the big companies like Google, Amazon, and Microsoft have other revenue sources outside of AI. So I don't think they're going anywhere, even if AI came crashing down. Lastly, interest rates were climbing up during the dot-com bubble, which made borrowing money more expensive, while interest rates today are coming down. Now, that doesn't mean that we're not in a bubble, but what it does mean is it can go on for longer and give companies more time to turn a profit. Okay, so regardless of if we're in an AI bubble, is this a good time to invest? Or is the stock market coming down? Well, because interest rates have been high, there's trillions of dollars sitting on the sidelines in money market funds that could be deployed if the market dips. Now, in terms of my thoughts, I do think that the stock market is valued extremely high right now, but that doesn't mean that I'm not investing. I think the most important thing is expanding your investing timeline. If we see a market dip, it could be a great buying opportunity, and I'm also keeping some cash on the sidelines, as well as I've also eliminated all of my high interest debts. I'm also not trying to pick one AI winner. I'm investing in diversified ETFs, and yes, we now know that they're not that diversified, but that's also why I'm investing in both US, international, and Bitcoin ETFs. Right now, I think it's more important than ever to have at least a little bit of cash on the sidelines in case the market takes a dip. And luckily, money market accounts and high yield savings accounts are still paying 3 to 4% interest. But what do you guys think? Is the market going to continue to go up, or are we in a bubble that's about to burst? Let me know your thoughts in the comments. Thank you guys so much for watching. Drop me a like and subscribe. It helps me a ton. And I'll catch you guys in the next one.